Thank you very much for coming here tonight, and if you're watching this online, thank you very much for watching this online, and we're sorry the live stream didn't work out. Okay, so yeah, my name is Tim Helm. I'm the Director of Research and Policy here at Prosper Australia. We're in the Prosper offices right now, as many of you have been here before. Do a little bit of context here. Is over the last couple of weeks, I've been in Sydney and Melbourne delivering this talk and a similar talk to a range of different audiences, and it's the product of some work with Cameron Murray, who's a regular collaborator with myself and even with Prosper before I joined Prosper. And we've been thinking about housing economics, the causes of housing supply, the role of regulation in housing affordability. We've been thinking about this for years. We've been following this increasingly heated public conversation and increasingly contested economic debate, and we've come close to being ready to put out some work that will be a Prosper report later in the year. And the one way I'd describe this work is it's our attempt to give a really clear explanation grounded in logical economics for what we see in housing markets and what we think will be the results of deregulating housing use, as is a really contested policy at the moment. What else will be interesting context? We've presented to a range of audiences, Australian Conference of Economists last week, a few planning audiences, some university academics, some uni students tomorrow, so on and so forth. So Cameron and I have been working on this. I may get time to get to some work we've been doing on Auckland and the experience of upzoning in Auckland, which has become really an article of faith that the literature, the evidence says that Auckland shows you that large-scale, widespread deregulation of land use is going to be some kind of silver bullet for housing affordability. And you probably met a former Aucklander in the street here today in Melbourne who left Auckland because of high housing prices, and you can ask them how true you think that story is. And Cameron and I have taken a different tack by going through the literature, and we're finding some dubious, I think, methods and claims, and certainly the blown up claims that emerge from this literature aren't really supported. So ideally I'll get time for that. The first talk though is really some economics and trying to make this plain language for non-economists. I'll do my best, but it's going to get into some terrain that's a little bit difficult, but hopefully I'm doing better than other economists in the public sphere at explaining this. So the topic is housing supply, the production of new housing, and our question is really fundamental and simple, which is, why are houses built? Why is new housing supplied? And superficially, it feels embarrassing to ask that question because you think all economists must surely have a shared view about the causes of housing production and also about the role of regulation in that process. But you'll find that no, these things are not well articulated, and there's some big holes in certain narratives. So we are in search of a theory that can explain the key empirical facts, the observable facts. So a really important bit of context here is that now amongst the economics profession, there's quite a large majority who will claim that easing planning restrictions will improve housing affordability. This is a recent survey. My question is, why do we believe this as economists? What's our shared theory of housing supply, the causes of housing production, and the effects of regulation within that theory? And one of the reasons for diving deeper into this topic, oh, blimey, it's just a laggy thing.
It's me. I'm gonna do it for you.
Okay, can we just have a crack at this? Because there's quite a few animations and things, and this lovely... Have you got a PDF up? Or are animations working? Is this...
Maybe not.
Is this a PowerPoint?
That's the PDF.
All right. No worries. It's all good.
Skip.
I thought I sent you a PowerPoint, but doesn't matter. All right, okay. Animations are off. Doesn't matter. They're not too crucial. You look at economics in the public sphere, you get these answers to these core questions. It's like it's trivially true. Everybody understands that upzoning land will make cheaper housing. You get the New South Wales Premier in Parliament bagging on my co-author Cameron for how could this PhD economist not understand something so simple? Or on the other hand, you have these quite arcane methods and empirical methods that you just have to trust in the numbers, and we've shown that house prices in Sydney are $500,000 more expensive due to regulation than they would be, right? But we can't intuitively explain why. And for me, these are just red flags. I'm trained in economics. I've spent a lot of time looking at this area. It's not obvious to me that the assertions are true, and I'm unimpressed at some of the explanations. So this is our attempt to dive a bit deeper into that. Okay, so the contents of the talk will be, I'm going to talk through a few basic economic concepts. We want a shared language before we start going a bit deeper. Then I'm going to point to two puzzles that economic explanation must contend with. Like, we want our shared theory of housing supply to be able to predict these two facts of what happens to housing supply and land prices. And these are tricky ones for your 101 take to explain. Then I'm going to step through 4 ways that economists have reasoned about production of housing, the models, if you like, that they use, and with that you'll see that it will emerge that there's one coherent way really to think about the causes of housing supply, and it centres on the role of land banking and vacant land. Maybe we'll just wait till afterwards.
Yeah, if you can define this supply, that'd be really helpful.
Sure.
Because it's a bit controversial.
Okay, we'll get into that. Yep. And then finally, we'll get into it because it is unclear what we mean by housing supply. So thank you for raising that. Yeah, and I'm going to give you different words that are more precise, and I will use those after. Finally, we're going to look at the policy implications of the most coherent way to look at housing supply, housing production. A couple of key implications. Oh, that did work. That's good news. Okay, so first basic concept, right? There's a couple of key prices that are referred to in housing markets. One is the rent of house, and one is the asset price. And they're actually measuring quite different economic concepts. They're different things. So rents are the price of consuming a housing service. You pay a certain amount for a week or a year, and you get a service. You get to live in that house. So that makes rents a really good measure of housing affordability, housing as a service. And the role of rents is to allocate the housing stock to the population and all their dollars. You think about that price helping to clear the market so that between all the houses that we have in the housing stock and all the people with the dollars and their preferences over housing types, rents of different housing types will allocate that stock. That's their role. And rents point you to the fundamentals of supply, how many stock, how many houses we have, and demand, which is our income and our population and our preferences for housing. And that's house prices serve a different role because they are asset prices. Houses are financial assets, just like shares are financial assets. Bitcoin is a financial asset. Some of these assets yield a stream of returns over time, and so the price you pay for the asset reflects that stream of returns capitalised into an upfront or present value. So that means house prices reflect interest rates and other asset pricing factors, as well as reflecting those fundamentals of the people, the housing stock, the people's incomes. And you can see that the two prices of housing obviously diverge significantly often. Housing rents they didn't really change in real terms in Melbourne for 20 odd years. They've risen a little bit in other cities, broadly in line with real incomes. But the asset prices exploded. And these charts can be replicated in any city around the world, essentially, because the decline in long-term interest rates is a global phenomenon. And that decline in interest rates has bid up all sorts of asset prices, from stocks to gold to crypto, whatever it is. Anything that's an asset that you can put your money in and ideally get a return, that's risen in price as interest rates have fallen. And that's a really, really key point. And you've probably heard that median multiples, like the house price to the median income, gosh, they used to be 3, now they're 8. Haven't we done a terrible job making houses? I'm like, no, that's just the fact of asset pricing at work. And it doesn't reflect an affordability problem if it's twice as hard to save $1 million as it used to be to save $500,000, right? That's just wealth accumulation. To save $1 million in housing should be twice as hard as saving $500,000. The single asset of a house, that indivisible asset has risen in price. That can raise deposit hurdles as a problem, but we shouldn't be surprised at those rising lines in the context of falling interest rates, and it's not a problem per se. If we're going to measure a housing affordability problem, we're going to see it in the rents relative to the incomes. Does work. Glorious. Okay, another thing to distinguish. You asked, what is housing supply? And that's a great question because supply has a really distinct meaning in economics. It's actually better for analysis that we use concrete terms like the housing stock, all the houses in Melbourne. And the stock, of course, results, like any stock, from a flow, and the flow is new construction. And critically, the rate of new construction, the 50,000 per year that we build in Melbourne, that doesn't just come from outer space. It's not random. It's not arbitrarily determined. It's the result of a market equilibrium. Market equilibrium being this core concept of economists that refers to a situation where no one can do better. So there's a market equilibrium flow. The number of houses the sector wants to build each year is governed by some underlying behaviour that we want to understand. And we sometimes call that flow the absorption rate. And you're hopefully aware that Australia is an exceptional global performer in production of new housing. And we've produced more than enough housing over 20 years to match the increase in population of that period, despite having one of the world's fastest population rates. So the percentage change in housing stock has exceeded the percentage change in population in Australia for the last 20 years or so. So we're not really doing too badly on the flow measure of how well we supply housing. But it's really important that if you want to grow a stock, if we want to have more housing so housing gets cheaper to rent and then to buy, we're going to have to increase the flow rate, right? If you want more water in the bath and it's going out the plug, you're going to have to turn on the tap. Okay, next thing. There's two things you can do with land. This is an important way to understand housing production. Housing development means development of land into housing. And when you have land, you can do two things. You can develop it, which means supplying new housing. That's where the flow comes from. Or you can not develop it, and you can land bank it. And that means to retain the option to develop it in future. So land can be thought about as an option, just like any financial option. You're aware of call options and so on, where you've got the right to pay a price and get an asset, a share, whatever it is. Land is an option to pay the construction costs and get the house price. And just like in financial options theory and practice, you don't wait just until the option's first profitable to exercise it. You might preserve that option to the right time. You might wait before exercising the option to buy a share, a particular share, or a piece of gold at a defined price. There's no reason you'd just jump straight away. So we can think about land development as exercise of an option, and there's always two options, or two choices, let's say. Exercise the option of swapping your land asset, getting some cash, or retaining that option by keeping your land asset. And that really prompts, on the part of developers, this is economic theory of what developers do, it means there's two choices. It's not just how tall you build your building, but it's when you build your building. They're critical economic choices. The agents involved, if you're an economist modelling this, they have two choice variables. It's not just how many dwellings, but it's the timing of their development. The timing choice matters, of course, because once you put a building up, you're not taking it down again, right? It's irreversible. Now, the diagram on the right, just for colour and flavour really, illustrates a situation when it may be better to hold your land as land, undeveloped land, and hold your, the potential construction cash as cash. And if the growth in your cash reserve and the growth in the value of your land summed together exceeds the return you would have got by converting those assets to a house and watching that house, the sales proceed from the house, rise in value in the bank, then it's optimal to wait. So this inherent trade-off between developing land today and essentially getting cash that you can put in the bank, or developing land later, that inherent trade-off is going to guides the decision of where the development actually occurs. And you can see immediately, if you're clued in at all to land economics or land policy, you can see immediately that we're getting into the terrain of using words like speculation and land banking as a constraint, I suppose, on housing supply. Now, there's one more key distinction that's often lost in policy debates, and I could afford a house if I had $1 for every time I'd heard someone say we need to upzone to allow more housing. Because what you get when you change density regulations, that's what the planning system restricts, that's what zoning rules restrict. They restrict how many houses are on a site. The the housing per area. So you can get more housing in the vertical dimension. But if you want a larger housing stock, you want to increase the flow rate of housing in the time dimension. You want more construction per year. So that's what I'm going to call a supply, or rate of supply, and that's regulated by the housing market, by market incentives, by economic incentives. Whereas the planning rules, what the planners do, that regulates the housing per area. And this is stupidly simple and extremely obvious, and you should look at me like I'm an idiot, but you will see over and over again, once you're clued into the different dimensions, you will see over and over again logic that elides the distinction between more housing in the vertical dimension per area and more housing in the time dimension per year. We want more housing per year if we want to make housing cheaper, all right? More housing per vertical area won't necessarily do it. And on the right here, I've illustrated this in a way by, well, there we go. On the horizontal axis, that's the time rate of housing production per year. And on the vertical axis, that's the height of buildings, the density of development. And you can see you can have a fast rate of development at low density. Of course you can. It means a lot of sites got built out. You can have a slow rate of development at high density, which means a lot of sites sat vacant. Or you can have a slow rate at low density and a fast rate, like 8 dwellings per year at high density. It's just all outcomes are possible. Planners always thought they were doing this. They said, all right, we'll change the look and feel of an area. And we know, of course, across a construction cycle that the rate changes, double housing production. Now, the new claim, by a fairly unsupported claim, is that by going up to higher density, we're going to go right to a faster flow from 4 houses per year to 8 houses per year. That's the claim. We'll see if we can find any rationale for that. Now, the real distinction here is that these concepts are linked, and it's that the rate of flow per year equals the houses per site times the sites developed per year. Okay, that's obvious. Now, the key point, not all sites that can feasibly be developed are developed. I was walking past a vacant lot in the Melbourne CBD today. I walked past that same lot a year ago. It was vacant then, it's vacant now. It's being held to the right time to develop. It's already feasible to develop. You could put townhouses on there. In the Melbourne CBD, you could make a buck. You could put apartments on there, you could make a buck. The reason people are not doing it is they're voluntarily choosing to withhold that land from productive use. And it's those sites like those that mean there's no necessary connection between the density allowed and the rate of production. Because that rate, the number of sites converted to housing per year, is a market decision, and it will depend in part on the density. Okay, so that was really covering off some sort of core economic concepts, and what I want to do now is pose a few puzzles that economic theory should address. And really the first one is this, as I've just alluded to. When you go around and you look for sites that could feasibly be developed, they're vacant land or they're land with low value structures where the value added by the new structures, net of development costs, exceeds the value provided by the old structures. You can call that feasible development capacity. And the word here, feasible, means something slightly different to what a developer means when they're thinking about acquiring land. They might say it's feasible to buy that land and develop it. We're saying if you own the land, if it's feasible to change the use, if it's profitable to change the use, then let's call that feasible capacity. And New Zealand, where I live, has some excellent measures of this. That's part of a national direction that local councils go out and measure and assess the optimal development on each site, the optimal density, and see how many extra dwellings could be profitably produced under the zoning rules. So to illustrate, really, a few years ago, Wellington had 100,000 as the extra zoning headroom, how many extra dwellings could be produced under the zoning rules, and any one of 35,000 of those could have been built immediately at a profit. But the rate that was actually built was about 1,000 per year. So only a tiny fraction of feasible capacity. And Cameron and I have been looking at the numbers, compiling the numbers across different jurisdictions, different land types. Greenfield land, Carl from Prosper a few years ago did a report called Stage Releases that showed how slow the rate of conversion of essentially farmland to housing was. Now that farmland, it's definitely feasible to develop because you're not getting any value out of holding it as grass, right? It's a different matter when there's an existing valuable structure on there. And really, as if to illustrate the lack of mechanical connection between zoning for more housing or higher density housing and the rate of construction, Wellington, about 18 months ago, changed this blue circle to be 450,000. They expanded it by a factor of 4, and the green circle fell to about 500 per year. So there's no constant rate at which capacity is converted into housing. That rate's determined by the market, and there's no reason, well, we might get into theory, but there's no reason up front to imagine that the rate at which developers wish to supply new houses to market, that absorption rate, will relate in any way to the amount of capacity provided. Or if there is, there'll be a subtle one, and it's worth investigating, and we'll get to that in theory. So we've got a puzzle about supply, the number of houses built. In other words, why do people land bank? And we've got another puzzle here that's about the pricing of land. And just trust me that all these screen grabs refer to developers saying, we can't afford to build because the price of acquiring land for construction is too high, or I paid too much for my land and I can't get the return I thought I'd get on it because house prices have fallen, construction costs have risen. And the reason this is a puzzle is that we know, especially people in this room, we know that land has no production cost. It's not produced in a market like the way coffees and other things are produced with inputs of labour and intermediate inputs. Land is already there. It's not produced like other goods and assets. And so therefore it doesn't really have a cost, it only has a price. And that price is determined by the value in use. That's all it can be determined by. And that value we usually associate with the value as for development, the development residual, the sales price of housing minus the cost of developing housing, the residual land value, as valuers call it. Okay, so why then are some developers saying that the residual land value of the best use of that site is too low to pay the market price for that site? Maybe your residual land value from the best development of that site downtown was $10 million, but the land is priced at $15 million, the bare land. So why would markets ever price land above the development residual? And we need theory to answer that puzzle if it's to be a coherent and complete theory of housing production. Okay, a little bit of dynamic animation, but not to worry. So I'm going to step through now really 4 ways that economists talk about, reason about, theorise about production of housing. And the first is the entry-level 101. The first time you encounter a problem as an economist, you pull out your supply and demand diagram, and you will often see in housing policy commentary people saying, well, look, housing is just supply and demand. Like everything else is supply and demand. Housing is just supply and demand. And sure, this is true. It's trivially true. It's always true. It doesn't matter. But to say that the reason houses are built, the explanation, the cause, is because people are willing to build them, which is what a supply schedule, a supply relationship says. To say that is just to beg the question of why people are willing to supply a Q1 number of houses at P1 price. Why? What is the underlying process of incentives that leads the collective of housing suppliers to be willing to supply housing in accordance with this curve or this curve? So supply curves and supply demand analysis, it's often referred to as a kind of reduced form theoretical approach. Reduced form meaning a shorthand for some deeper process that we think goes on in the background. Now the problem is, if you're going to do policy reasoning, how policy affects prices, you're going to have to reason, you're going to have to understand that deeper process to understand how a policy like upzoning land is going to shift this curve. If you don't do that, you'll fall into some very ad hoc reasoning. And best in class for ad hoc reasoning is the Productivity Commission a few years ago that had a report on housing. And maybe unsurprisingly, if you know the priors of the PC, it claimed that deregulation would make housing cheaper. And they also, if you know the PC, you know they are very, very logical, and they stepped through everything point by point by point. But at some point, they had to assert that they had to assert that deregulating land would increase the elasticity of supply and therefore reduce price pressure from future demand growth. But they couldn't argue it, and they tripped over their feet doing so. And it's an example of why we need deeper theory to do good policy prediction. Probably not for any of you, but for the Economist Conference, I wanted to point to a real red herring in arguing about the role of regulations in house prices. And it's a particular type of model that's called the Alonzo-Muth-Mills model, or the urban spatial model. And it's a model that has geographic location embedded in it, typically distance from a CBD. So it imagines kind of a symmetrical city, like a slice, a cross-section of a city. And it says, okay, there's a certain population, they have certain preferences, certain building costs, and in an equilibrium, the price of housing will be closer to the centre in this way, and so the heights of buildings built will be higher, closer to the centre, and density of population will be higher, so on and so forth. So that's the essence of the model. But if we're to ask whether this answers the motivating question, why are houses built? Really the answer is houses are built to the optimal density for the location. Okay, it doesn't tell us why. There's no explanation of the cause. Why is housing built in the first place? We know that in the real world, buildings do not gradually go down to the centre like that. It's a lumpy thing. There's vacant land, there's buildings that are old and not worth redeveloping yet. So this model doesn't have any development of land. It's just a theory of the optimal density to build new housing. It's not a theory of the rate of supply, the flow rate. Nonetheless, you will see people say things like, all right, in my modelling exercise, I have found that by restricting building heights, I've raised house prices. And that's just a mechanical, automatic consequence of your assumptions. It's proof by assumption, and this model should be written out of this kind of reasoning. Okay, this one's getting a little bit techie, but some economists have said, okay, housing production, it's not just supply and demand of haircuts, which is recurrent. Housing is an asset, so it needs to be governed by investment incentives. And investment occurs when, specifically, investment assets are produced when the price of that investment asset exceeds the costs of producing that asset, which is logical enough. It's logical enough. What it means is that some economists have reasoned that housing production can be thought about as a process of blind arbitrage between prices. Arbitrage being the thing you do when the US dollar relative to the Australian dollar and the New Zealand dollar is slightly high or low, and you can make some money on the trade, right? Imagine three currencies and they're not quite in alignment, right? You get it. That's arbitrage. Now, people have said all we need to know about housing production is that developers are in the business of comparing house prices to construction costs and to land prices, and any time the top line, the house price, exceeds that plus that, development happens. And this is true and reasonable. It's essentially an accounting identity that these things should add up in an equilibrium, but it's empty as a theory of why the production happens. And it's empty because we can't explain where land gets its price from. You can always say, we can explain where construction costs come from. They come from what you got to pay the tradie to show up. They come from the cost of the materials, and those are produced in other markets. But land is not produced in another market. So we need to explain the land price if we know when this arbitrage process is supposed to kick in and produce a new house. So that means such a theory, an idea that developers aren't thinking about the future, they're just arbitraging. It can't explain the land price, so it can't explain the process of supply. It's not a causal theory that matters. And this, in essence, is probably the first novel thing that Cameron and I have sort of realised. There's actually a stack of empirical papers out there, published in top journals, a lot of economists who have said, let's test the so-called Tobin's Q theory of housing investment. Gosh, it seems to hold. Well, that's sort of, it's unsurprising, but what does it tell us about the actual causes, the underlying causes of this? We need some explanation grounded in what economists call micro-foundations, the incentives of the individual agents involved. So what we need, we're in search of a joint theory of the determination of land price and the supply decision, the development decision. Forget about the thing on the right. It's just a silly proof by contradiction. Okay, it's a lot of text, but the short version is there's one sensible way to think about why houses are built, and it's to imagine that developers look ahead to the future. If not individually and rationally, at least the market behaves as if enough of them do to constrain the price. You can have these emergent equilibria in markets that are not necessarily, that the equilibrium can be smarter and more rational than the behaviour of every individual involved. That's a key insight in economics. And what we see is that the equilibrium rate of production is that houses are built when it's more profitable than banking land. I alluded to this at the start. But Cameron and I, our point really is that this concept of land banking has had no role at the centre of economics. The economics of housing supply has not really made reference to land banking, and sometimes, such as in the Productivity Commission's report, there's been strenuous efforts to deny any relevance for the concept. In their view, all land is already built, or any land that's profitable to build is built immediately, and we don't need to worry about a distinction between zoned density and the rate of supply because every site's used. Now, it just doesn't take a genius to look at sites that are vacant and realise this is not a good empirical description of the world. But the genius is, oh no, I'm going to be mean, so I won't. you knew where that was going. So, yeah, really, this viewpoint on the world and the cause of housing production answers our two puzzles. It explains why feasible capacity is not built. You only want to build when the returns to development exceed the returns to delaying development, which is that your land price can grow in value. That asset, that financial asset, is worth a lot as undeveloped land. Why throw it away and convert it to cash prematurely? Yeah? So it puts a central role for land banking, and I like to express it that housing supply only begins when land speculation ends. They're two sides of a coin, aren't they? Developing a site or holding that site for future growth. And so to pretend that you're really interested as policy analysts in the development decision, but you think there's no relevance to the non-development decision, is to sort of craft a silly distinction. Because if you want to understand why anyone doesn't develop, you need to understand why they would want a land bank, the growth and the value of asset. It's entirely obvious once you look at it this way. Second puzzle explains why land prices exceed the current residual land value. So in other words, the explanation is that the land price is set as the present value or today's value of the residual at the optimal time to develop. State government says they're going to build suburban rail loop here and there. Would you build a tall tower today, given political risk, given insecurity about development timelines? No, you'd wait. The optimal time to build is later for land located right there. But would you pay more today than the land is worth as a single dwelling? Sure you would, because there's a strong possibility there'll be a great train line running past. So it's really simple. The puzzle gets explained by the fact that people are rational and looking forward to better times to develop. So in economics, what Cameron and I are doing here is just reframing existing work in coherent language, like land banking, speculation, language that makes sense to people. Many economists have modelled this in mathematical models, empirical papers. There's dozens of relevant papers. And the technical tool they use is called a real options or timing choice model. And if you want to be wonkish, the agents in this model are choosing a timing of development. They have a certain objective. There's a market equilibrium, and in that equilibrium there's an equal return on developing and waiting. If you can get a higher return from developing the land than banking it, then you should develop a bit faster. If the opposite holds, you should develop a bit slower. There's a rate and there's an optimal speed to develop out your land. And across a market that produces an absorption rate, which interestingly means your asset will grow at the market rate of interest. And yeah, that's actually a very old insight going back to Harold Hotelling, 1931, who talked about the harvesting of natural resources like trees or minerals. And in fact, harvesting of land for housing development follows all the same principles as harvesting a forest. You don't want to harvest straight away. You want to harvest in a way that maximises the value of that long-lived asset. And it's the same for harvesting land into housing. Okay, there are 4 ways to talk about housing supply theory. There's one that actually can match the facts and explain those key facts. What does it mean? First thing it means is this. We have no grounding in this body of logic and theory for the idea, the claim that upzoning will speed up the rate of supply. Zoning for higher density does not, in most circumstances, speed up the number of houses built per year. You're not going to get cheaper housing. You're not going to increase the stock. You're not going to increase the. You're not going to increase the flow rate. You're not going to increase the stock, right? So there's actually just no claim. It's baseless in terms of logic, economic logic and reasoning, this idea. Maybe there are empirics. I might come to how weak they are, but we have nothing in economic theory that can support this view. And in essence, the reason is that you can, raising the density you can build a site increases the profit of building it out today, but also the profit of building it out tomorrow. So it's not changing your incentive to delay development, to develop today or delay to tomorrow. So it doesn't systematically pull forward development. And getting wonkish, but there are even some models, such as this one, 1985 American Economic Review, subsequently forgotten by everybody, showing quite clearly that more restrictive zoning can encourage faster development of land, and upzoning can encourage more speculation. And I'll illustrate it, even though I don't think it's necessarily generalizable, it's showing you, and it helps illustrate an important point. So imagine we got a site and it's zoned for 2 stories, low density. Well, your choice is to develop at the optimal height now, 2 stories, and get $2 million in present value of revenue. And if you wait, you can still only develop at 2 stories tomorrow, and maybe you've missed your chance. The construction costs have risen or whatever. So in today's value, you'd get $1 million. So you prefer the higher one, so you develop the land now. If you have an additional option in future to develop to 4 stories, then you've got 2 possible reasons to wait. 1, the price of the house might go up, but 2, the number of houses in your optimal built form might change. And so it may be that developing tomorrow at the best height for the land tomorrow exceeds the return you get on developing today. So upzoning that land might cause the person to delay development. I don't think that's a generalizable, it's not going to cover all behavioural situations in the economy, but it just illustrates the logic that your reasons to delay development are the constraint on how fast you choose to develop land today. My old lecturer in New Zealand happens to be a global expert in real options modelling, very interested in the current debates, came out of retirement to construct this complex theoretical model with computer simulations and modelling the joint choice of developers on density and timing, and says, well, look, there's no reason. It sort of depends in this model on the parameters. There's just no smoking gun here. More text that I would step through slowly, but apologies. This is relevant. There's a strand of literature sometimes called zoning, the zoning tax literature. And the premise of this literature is that regulation of land use acts like a tax, and that tax acts to push up prices. And the best known example in Australia is Peter Tulip and Kendall, for the RBA a few years ago, that did an empirical modelling exercise and found or claimed that houses in Sydney were $500,000 more expensive than they would be in a free market world, right? So that's sometimes referred to as zoning tax literature, and there's actually a lot in this genre, a bunch of methods. What they all have in common is that there's a claim here that the price of land per house exceeds some underlying free market cost of land per house. It's an inherently moral claim. Land should cost less than what it actually costs. If it costs more, we've been naughty. You naughty planners, you've been naughty, right? So in other words, we can take the land price or the house price and decompose it into a good bit, a natural, healthy bit. It's like a cost, and a bad, naughty bit, which is like an excess profit. And it's as if the government imposed a tax on you, the house consumer. And let's see, where do they get some of these underlying free market costs from? There's a bunch of benchmarks, right? The Peter Tulip method that was pioneered by a dude called Glaser in the US says that the value of your land, your site for development, should be set by the price of marginal land in the same location. So if I own a 101 square metre lot and you own we look at the value of that last square metre to get that last square metre from 100 to 101. Maybe it's the shady corner at the bottom of your garden, right? What am I prepared to pay for a shady corner? See what the market's prepared to pay for a shady corner, the marginal price of land, multiply it by the lot size, and if lots cost any more than that, you've been naughty, right? So it's ridiculous because it's premised on the idea that somehow people would post their shady corner to each other, right? Or they would all like shuffle their houses over a bit and free up a new lot. It's actually just insane. And yet, because it's written, well, anyway, forget the sociological crap. It's, that's one method. New Zealand has a kind of embarrassing obsession with the price of farmland. You'll understand why that's embarrassing. Many people, including the New Zealand Treasury, claim that the price of land for housing should be the same as the price of land that you're only allowed to farm on.
What?
And, well, they say that the value of the right to use land for housing should be worthless. And that's a really strange claim. It's a really strange claim. Land is just a bundle of rights to use stuff. You don't get to use the dirt, you don't get the minerals, you don't get the airspace that the planes are flying in. All you get is a codified bundle of rights. You don't get the right to make drugs on your land. You do get the right to build a two-storey dwelling. The New Zealand Treasury says if we've done things right, those rights are worthless. So in other words, the right to put housing on should be priced at zero, which is to say all land should cost essentially the same. Anyway, the issue with this whole literature is these supposed free market prices of land based on such benchmarks are not grounded in the only coherent theory of housing supply, which is showing the value of land as emerging from the value of an option and emerging from what you can do with the land later. They're all ad hoc. It's just people like looking at their fender, holding it in the wind and saying, I reckon land should be about 25% of the construction cost. Right, well, why? Like, there's no logic, there's no explanatory logic. The whole literature's flawed. Worthless. You learn nothing about the true value of zoning from this literature. If there's an effect of zoning restrictions on house prices, it's happening by slowing down the rate of supply, and we don't have good cause to think that's the case. It's an emerging frontier in research, so it's possible we'll find solid reasons, but right now we don't. And to really close off everything, the issue is that they're claiming there's a cost of land, and they're pegging it to some arbitrarily chosen benchmark. The true cost of land is cost being opportunity cost. That's the economist's concept of cost. The opportunity cost of using land for housing today is simply the value of using it later. That's the next best alternative to using it today that defines the opportunity cost. And the value of using it later, well, we've got a nice market metric for that, and it's called the price, right? So, in other words, the only sensible concept of the cost of land for housing is the price that people are trading that land at, which is another way of saying land doesn't really have an underlying cost, it only has a price. And the essence of that price is it's not broken into natural and healthy and good bits and naughty bits that policies generated. It's all a rent all the time, and that takes us naturally to the sort of Georgist diagnosis, which is that we can't break that monopoly, we just have to redistribute the proceeds. So that brings us to the end of theory.